There are two certainties in life: death and taxes. No one looks forward to these. But I think there's another certainty in life that's worth talking about. That's the many ways to reduce your tax bill. In today's video, we'll be going over the methods used to reduce your taxes. So whether you're a first-time tax filer or a seasoned veteran, today's video is for you. After all, who doesn't want to pay less taxes? Let's get started. Just a reminder that we are providing general tax information about taxes, and it's important to talk to a tax and legal professional about your specific situation. Let's talk about tax deductions and credits. Tax deductions reduce how much of your income is subject to taxes. Deductions lower your taxable income by the percentage of your highest federal income tax bracket. So if you fall into the 22% tax bracket, let's say, a $1,000 deduction saves you $220. There are two types of deductions: the standard deduction and the itemized deduction. Basically, you take whichever one saves you more taxes. The standard deduction is a preset amount that you are allowed to deduct from your taxable income each year. This amount will vary according to your tax filing status and is indexed annually to keep up with inflation. Tax credits, on the other hand, directly reduce the amount of tax that you owe, giving you a dollar-for-dollar reduction of your tax liability. So a tax credit valued at $1,000, for example, lowers your tax bill by the corresponding $1,000, one for one. When you file your tax return, the biggest opportunity to reduce your tax bill comes in the form of these itemized deductions and credits. So let's talk about some of the most common itemized deduction. One common itemized deduction is the medical expense tax deduction. If you or your dependents have experienced costly medical or dental expenses, these bills could actually help reduce your tax bill when it comes time to file. Taxpayers can deduct qualified, unreimbursed medical expenses that are over 7.5% of their adjusted gross income. So for example, if your adjusted gross income is $150K, anything above the first $11,250 of medical bills, or that's 7.5% of your AGI, could be deductible. Some expenses that the IRS counts as medical expenses include payments to doctors, hospital and nursing home care, acupuncture, addiction programs, and weight loss programs, and more. We'll leave links to the full list of the qualified IRS expenses in the description below. YouTube is a great place to learn all the financial 101 lingo that we never learned in high school and college. I'm here to teach that. Hit subscribe and follow along. Now with the next deduction, if you're a homeowner, you're in luck, because there are many ways to reduce your taxes. The mortgage interest deduction allows you to reduce your taxable income by the amount of money that you've paid in mortgage interest during the year. If you have a mortgage, the interest you're paying could actually help cut your tax bill up to a certain limit. In general, you can deduct the mortgage interest that you paid during the tax year on the first $1 million of your mortgage debt for your primary home or a secondary home. If you bought the house after December 15th, 2017, you can deduct the interest that you paid during the first year on the first $750,000 of the mortgage. So you might be wondering, what qualifies as mortgage interest? The most obvious and most common is the interest that you paid on your mortgage for your primary or second home. If you took out a home equity line of credit, any interest paid on this also qualifies. We'll leave a link in the description below for some of the more uncommon use cases. The property tax deduction, another common itemized deduction for homeowners, allows you to deduct the state and local taxes that you've paid on your property from your federal income taxes. This includes the annual property taxes on the value of your house, as well as any taxes that you paid when closing for the sale or the purchase of that home. You can deduct up to $10K in state and local taxes, which include those property taxes per year. There's also the capital gains tax break for homeowners, which comes into play when you sell your home at a profit. The current capital gains rules allows single taxpayers to exclude $250,000 in profits on their home sale, while married couples who file jointly can exclude $500,000 from their taxable income. To qualify for this exemption, you must have lived in that house for 2 of the last 5 years. Here's an example of this capital gains tax break in action. Suppose a married couple bought their home 8 years ago for $200,000 and lived in it exclusively since that purchase. Now, they sell their home for $450,000. Because they file jointly, they will qualify for the capital gains exclusion and have no tax liability on the first $250K of the profit, which covers the whole thing. It's pretty nice. But let's take that same situation and say the couple is selling their home for $1 million for a profit of $800,000. The couple will qualify for a maximum of $500,000 in capital gains exclusion if they file jointly. Therefore, the couple will have to recognize capital gains taxes on $300,000 of the profit. That's $800,000 total profit minus the 500K exclusion. That's still some significant tax savings. They just gotta owe taxes on this one. Next up, we have the Employee Stock Purchase Program, commonly referred to as an ESPP. If you work for a publicly traded company, it's likely that you have the opportunity to enroll in this program. An ESPP lets you buy your company's stock at a discount to the fair market value, typically 15%. There's the first part of that savings. Now, usually, you make contributions to the ESPP through payroll deductions, which reduce your adjusted gross income and corresponding tax liability. Then, at certain periods throughout the year, your employer will use the accumulated money in the fund to buy the stock for you. When your employer buys the stock using an ESPP, you don't owe any taxes. But, depending on when you are planning on selling the stock, you could avoid significant taxes by only selling your ESPP stock for a long-term capital gain, which is lower than the regular income tax rate. Here's how. When selling your stock, it'll either be classified as a qualifying disposition or a disqualifying disposition. It's kind of hard to say. A disqualifying disposition, there we go, is when you sell the stock within 2 years of the offering date or within 1 year from the purchase date of the stock. The offering date is when you first enrolled in the ESP program. If your stock sale is classified as a disqualifying disposition, then you'll pay taxes on both the bargain element of the stock purchase as ordinary income and any additional profit that's taxed as a short-term capital gain, which is the same tax rate as ordinary income. It can be quite high. And when I say the bargain element of that stock purchase, I just mean the difference between the discounted price you purchased the stock at and the actual market price of the stock when you bought it, the fair market value. So if I purchase my company's stock at a 15% discount when the market is pricing the stock at $100, my bargain element is $15. On the other hand, a qualifying disposition is if you are selling the stock at least 2 years after the offering date and at least 1 year after the purchase of the stock. If this is you, that bargain element is still considered ordinary income, while any additional profit is considered long-term capital gains. These long-term capital gains are taxed much lower than ordinary income for most taxpayers. Here's an example to show you how all of this works. Let's say your company's stock is trading at $100 again on the public market. Suppose you get a 15% discount through the ESPP, so your payroll withholdings end up purchasing 100 shares at $85 a share. Now let's say the price of the stock goes up to $125 before 2 years of enrolling in your ESPP and 1 year of your stock purchase date. If you decide to sell your shares now, you would make $4,000. But since this was a disqualifying disposition, the entire $4,000 of gain would be taxed as ordinary income, and that can be quite high. Now let's take the same scenario, but assume that you were trying to sell your shares after 2 years of starting your ESPP and a year after you buy the stock. If you sell now, this is considered a qualifying disposition, and your taxes on the gain will be split into 2 different parts, the bargain element and the additional profit. Since you purchased the stock when it was at $100, but for a discount of 15%, that's a $1,500 discount that's taxed as ordinary income. But then the remaining $2,500 gain is taxed as long-term capital gain, which has significantly lower tax rates for most taxpayers when compared to ordinary income. That's a lot of tax savings with just buying investments at a discount. Even if you don't work at a public company, there are still ways to reduce taxes through your paycheck withholdings. Did you know that boosting your 401k contributions can actually reduce your taxes? Here's how. When you contribute to your pre-tax traditional 401k, you reduce your adjusted gross income, which as a result reduces your taxes by the contribution amount multiplied by your marginal tax rate. The higher your income and the higher your tax bracket, the more significant that your tax savings could be from simply contributing to your retirement plan. But what's even better is that there's a higher 401k employee contribution limit for 2022, which means you could get an even bigger tax write-off to put money aside for retirement. In 2021, you could only contribute up to $19,500 to your 401k. Now in 2022, thanks to the costs of living adjustments from the IRS, you can contribute up to $20,500 to your retirement account. Let's say that you are a single earner who makes $200,000 a year, contributing the max $20,500 to your 401k each year. Since $200,000 puts you in the 32% tax bracket, your tax savings from the max contribution could be $6,560. That's not bad. Since your 401k contributions are made pre-tax, your employer will not include these contributions in your taxable income. So if you made $200,000, let's say, and contributed $20,000 to your 401k, all else being equal, you would only end up with $180,000 in taxable income. The 401k gives some serious tax savings as well. Last but not least, my favorite, we have tax loss harvesting, something that almost everyone invested in the stock market can take advantage of, but not enough do. Here's how it works. When a security in your portfolio, an ETF or a stock, declines in value, meaning that it's currently sitting at a loss position, tax loss harvesting could mean selling that security, recognizing the loss, then reinvesting the cash right away in a substantially similar security. So you're still properly diversified, and the risk structure of your portfolio likely does not change. Here's a quick example. Suppose an individual invests $10,000 in an ETF at the beginning of the year. Now this ETF has decreased in value by 10% and drops to a market value of $9,000. If you sell this ETF and incur the loss, this would be considered a capital loss of $1,000, which is also referred to and known as $1,000 in harvested losses. But how does this actually save you money on taxes? Well, the IRS actually lets you use investment losses for investments that you've sold to offset a few different things. You can first apply your harvested losses to offset short-term gains, if you have those. You can then use them to offset long-term gains. You can also reduce your taxable ordinary income by up to $3,000 per year if you have any losses left over. Or you can even carry forward your tax loss to future years if you don't have the opportunity to use them. Let's go through each of these in a little more detail. So the first one, you can use those harvested losses to offset other capital gains, basically from when you sold another investment at a gain. This includes capital gains from investments sold within the same platform, like if you use Wealthfront, or even on other platforms as well. The IRS does not care. If your capital gains are short-term, meaning you sold them less than 1 year from the purchase date, the IRS taxes you on this amount according to your federal ordinary income tax rate. Now, if your capital gains are long-term, you're taxed at the long-term capital gains rate, which is 15% if you make over 81K or 20% if you make over 500K. Now, the next one you can do beyond capital gains is you can actually use these losses to offset ordinary income, which is basically the main source of your tax bill every year, right? For most people, it's your income. This is your income from your day job, freelancing gig at night, passive income, whatever you do to get by. We all see the taxes withheld from our paycheck each week, right? Haven't you ever thought about how you could pay fewer taxes without having to do anything? I mean, of course you have. We all think about it. Lastly, you can save extra losses for future years if you don't have any other capital gains to offset and you've already used the maximum $3,000 ordinary income benefit, or simply just don't have any ordinary income for the year. The losses get set aside and are available for you to use in the future. So let's imagine that by the end of the year, you've harvested $4,000 of losses and realized $500 of capital gains. Come tax time, you could apply those harvested losses to offset those capital gains completely, meaning you would owe no taxes on those $500 of investment gains. Of course, you'd still have $3,500 of losses left over to use. Each year, because you're allowed to use harvested losses to offset $3,000 of ordinary income, you could apply $3,000 of your remaining losses to offset $3,000 of ordinary income. If you would have otherwise paid a marginal federal tax rate of 24%, the amount you'd save would be $720. The higher your tax rate, the greater the value of the harvested losses it could be. After that, you'd still have $500 of losses left over. The good news is that you can carry those losses into the next year, or as long as it takes for you to use them. So you may be thinking, that's great, I'll go do tax loss harvesting. Well, tax loss harvesting can be nearly impossible to do on your own. Here at Wealthfront, we do this for you through our automated tax loss harvesting software. We look for opportunities potentially every single market day. And on average, we've added an extra 1.8% to our clients' after-tax returns with tax loss harvesting alone. If you're interested in this service, we'll leave a link for you in the description below. That being said, I hope you enjoyed today's video and learned some ways to reduce your tax bill. We all want to reduce the amount of taxes that we pay. Don't forget to like this video and subscribe to the channel. Thanks for watching, and I'll see you in the next one.